You know, Logan Delany, the stock market took a 650-point header today after the president announced a 25% tariff on Canada and Mexico tomorrow. And I was just looking at the headline in the Wall Street Journal, who says Trump takes the dumbest tariff plunge in history. Your thoughts?
Well, there's a lot of uncertainty with these tariffs, and I think the biggest, the thing that the stock market likes least is uncertainty. Now, generally speaking, I happen to be a free trade advocate, but I do think that there are certain exceptions to free trade and tariffs. And you know, one of the things is when the people that you are trading with have constraints to international trade, it makes sense to use tariffs to negotiate the reduction of those trade impediments.
You know, Don, Furchtgott-Roth, it's strange. It seems as though this administration is punishing its allies and rewarding adversaries.
You're absolutely right, Armstrong. I mean, a 25% tariff on Canada, plus a tariff on steel and aluminum that comes from Canada. Canada makes these things in a very clean manner. Canada is our ally, and Canada is trying to reduce illegal immigration and also reduce the flow of drugs into the United States. That doesn't make sense at all to me.
You know, Jordan, and what about the consumer? If you want to return them to stability, they wanted better economics for their households. I mean, isn't in the long run, it is the consumer that will pay this price, and it's going to be a huge backlash?
In the short run, Armstrong, it's going to happen pretty fast. Those prices, those 25% higher prices, are paid in the short term by the importers, but then it's passed on, for the most part, to consumers. And we have a huge trade deficit, and therefore all the stuff we're bringing in is going to cost that much more. Some perishable things like fruits and vegetables and steel and cars and all kinds of things, it's going to cost consumers more for sure.
You know, speaking of cars, I don't think people realize that some cars, the prices will increase from $3,000 to $5,000 to $9,000 to purchase that vehicle. I don't think people understand just the significance of this. Dr. Fofack, what do you think the president's thinking is? What does he think is going to really happen that no one else can see?
I think the president is really in a zero-sum game mindset. And which reflect the fact that, as you mentioned, the U.S. has large trade deficit with Canada, Mexico, and China as well. And he's really concerned about reducing that deficit. And that's what's driving its push for tariff across the board. But I fully concur that there will be a cost for U.S. consumers, specifically in terms of, potentially, in terms of inflationary.
Ms. Furchtgott-Roth, what are your thoughts on what you've seen so far in the first 30 days in terms of his economic policies?
I think President Trump has done a wonderful job. My area is energy and the environment. He's rolled back a lot of these environmental regulations. He's allowing people to choose the car they want to drive. He's getting rid of the mandate for EVs. He's getting rid of the regulations that prevent natural gas power plants and coal-fired power plants from being put into place by getting rid of these tax incentives for wind and solar. And everybody knows that the top 10 states in the United States in terms of electricity prices, they require wind and solar. The bottom 10 states in terms of electricity prices, with Utah at the bottom with 11 cents per kilowatt hour, they don't require renewables. And if we want to lower the price of electricity in the United States, we got to get rid of these tax incentives for forms of energy that drive up our electricity prices.
Dr. Fofack, what concerns you about what you've seen the last 30 days? Are you concerned more about the policy or more about the form?
I think it has to be combinations of both. I think on the policy side, it's quite interesting to see the speed at which President Trump has actually executed some of his policies. If you look at the USAID scandal, you look at what he's doing in terms of making sure that we have more investment coming into the US. I think he's done a fantastic job on that. And that may actually be the path for him to rebuild the middle class and in the process create the conditions for income growth. And on the reform side, I have to say that there are things that he could have done differently, that he could do differently, and achieve the same result without creating the sense of angst within the country. I think that's where I have some concern.
You know, Jordan, the top 10% of earners account for nearly 50% of all spending. How does this level of consumption influence markets, trends, and the economic growth?
You're right. It's the top people, and it's grown dramatically. I mean, as you say, currently, the top 10%, those earning over $250,000, is 50% of spending. But 3 decades ago, it was 36%. So the higher income people are spending more and more and having a bigger impact on the economy. Just to give you a few other numbers about the same kind of thing here. In the last year, high-income consumers spent 12% more than the previous years. Middle and lower income, 80% of the population spent 2% less. So high-income people are spending more, and they're spending it on high-income goods, handbags and cruises and fancy cars and real estate. The value of their real estate portfolio has gone up a lot, and the value of their stock portfolio has gone up a lot. And people who don't have those assets are not benefiting by this asset inflation. So that's widening the gap, I think, pretty dramatically.
Logan, in what way does the spending behavior of the wealthy differ from that of middle and lower income Americans?
I'm sorry, I had trouble hearing you on that.
Diana, your response?
One thing that the wealthy can do is spend more and spend more consistently. So they don't have to necessarily cut back when there's a downturn in the economy. And this actually helps middle and lower income Americans also, because there's a lot of products that rely on a constant amount of spending. And if you have a group of people that's continuing to spend, then a company can keep prices the same. I mean, let's look at cars, for example. There can be a basic Ford, then there can be a Ford with a lot of trim and more gadgets. The wealthy people buy the one with a lot of trim and gadgets, but that helps subsidize the basic model that people who are middle income can buy. So it's not necessarily bad for the economy if we have a consistent set of spending that just keeps going no matter what. That's what we want. We want spending to keep going.
I'm sorry. Dr. Fofack, does the heavy reliance on the top 10% for consumer spending make the economy more vulnerable to downturns or recessions?
Oh, definitely. I think there is a concentration risk of having excessive dependence on 10% of populations. And that concentration risk is also reflected in the way, in the pattern of consumptions. And we now have a model whereby the distribution of household consumption has become essentially a unimodal, driven by one group. And what are they consuming, essentially? If you look at what we call the jet industry, the aerospace industries, and that specific sector has actually increased by 28% since 2019 in terms of access of the purchase of jet, private jet. And the figures suggest that they will increase by 1/3 by 2030 to 33. So there is a real issues there that they're essentially going toward high income, high-end services, high-end goods. And we mentioned the private jet, but also we can mention the tourism industries. We can mention Louis Vuitton is now getting into the US market, and which is also another high end. The risk that we see is that if there is any shock, let's say, in the market, for instance, that group which is actually driving overall consumption will have a major side effect in terms of overall economic growth. But there is another risk that we can think of. The excessive dependency on that group, which rely on high-end goods and not on basic goods that we see that actually drive the economy, and which is the household consumption basket. That's what we need. And we need to have a broad-based demand for that good to sustain consumption and drive growth. And this is important because consumption today accounts for more than 70% of US GDP growth. It has to be broad-based.
You know,
On the other hand, if you have an airline and it's charging more for first class and it's charging more for business, then it means they can have these basic fares and other people can travel for less because they can take the basic economy fare. Because United, American, Delta, they're making more from these first class and business class fares.
And I think you make an excellent point. And what you're saying, they really subsidize them so they can have a more affordable fare.
Right, exactly. And I think that that's positive, yeah.
So, Jordan, I know you want to respond to some of that, but I'm curious to know what policies or economic shifts could diversify spending power to strengthen our broader economy.
Well, I mean, what's going on right now is the middle class is really going to get hurt. I'll just give you one example. In the budget reconciliation bill, they're talking about $880 billion cut in Medicaid. Okay, that's going to hurt a lot of Americans and take away their spending power. They're not going to have the ability to get health care. They're going to get sicker and so on. Meanwhile, the tax cuts, which are going to expire at the end of this year, if those are extended, the vast majority of those $4 trillion in tax cuts goes to middle and particularly higher income people. So it's all the policies that are going into a place right now are going to widen the wealth gap dramatically, it seems to me.
Logan, is there a risk that businesses will focus too much on catering to the high earners, leaving middle and lower income consumers underserved?
I don't think that if there's a risk that it's, or there's a danger of, look, businesses apply to what the market is, and they respond to the markets. And businesses usually don't look at whether their customers are high or low income spenders per se. They target certain markets, and they address those markets, and they have price points which are targeted to those markets. So you always want to go where you're going to make your biggest profit. So if you're saying to most businessmen, like myself, you make some products that cater to the low end of the market, you make some that cater to the middle end, and you make some that cater to the high end of the market. And there's a lot of market segmentation that's done by business people. And that's determined by market forces.
I'm Armstrong Williams. This is Your Voice, Your Future. We'll be back. You know what's fascinating, Diana, is that the wealth in the rich class changes constantly. There are always people going out and people coming in. It seems as though that the lower income basically stay the same. There's just not a whole lot of dramatic movement there. Why?
Well, you look at you look at the income quintiles, and you can see that average income is, say, $50,000 a year. But you don't see that people are moving through income classes. So someone in high school, they have a minimum wage job. They graduate from college. They're making maybe 40, 50,000. They get married around 30. All of a sudden, two people making around 60,000 each get married. Boom, they have a $120,000 household. And then they keep moving through the income group, and they peak at 50 or 60,000 at age 50 or 60. And then they go down again. So it's not the same group of people all the time. The top 10% isn't the same people. The bottom 10% is not the same people.
So,
but I think the margin, if you look at the gap between the variation in what you're talking about, maybe within 5-10%. I think the bulk of it remained the same. The variation due to economic shocks is in such a way that it can actually affect more than 50% of the population in that particular group. It's very marginal, I would say. So statistically.
Yeah, so there's data from Treasury, people like Gerald Orton, they've done economic studies. Being at Treasury, they can look at individuals and see how they move through the income groups over time. And that shows that basically most people are moving up, you know, maybe 1 or 2 or sometimes 3 or 4 quintiles. And this is a constantly changing process. Yes, there are some people who are stuck at the bottom, but the vast majority of people, as their life cycle goes on, they earn more, then they marry somebody, and then married men with children make a lot more than married men without children.
But the point I'm trying to make here, if I may, is that when you look at the U.S. distribution today, about 12% of the U.S. is classified as poor. That's about 44 million, which is very huge.
Yeah.
And that group is actually, it's almost constant. The marginal variations...
Doesn't change much.
It doesn't change.
No, and that was my point. It doesn't change much. But so Logan, let me raise this with you. This is taking me into the direction I had not considered. What percentage of the wealthy derive their wealth doing business with the federal government?
Doing business with the federal government, you say?
Yes.
I don't think it's that high, Armstrong. I mean, there is a certain segment, and I think it's hard to estimate exactly what it is, but there's certain segments that, you know, almost exclusively, you know, like, you know, the military segment, you know, airline, aircraft manufacturers. But I think most businesses are not reliant on government. You know, most of the private businesses that I know and in the segments of manufacturing that I do, you know, we have maybe about 5% of our business we do with the government, you know, where we do some military contracting. So I think it depends on the business, but I don't think it's a very high percent. If I had to pull a number out of the air, I would be surprised if it's more than, you know, 10%.
That's interesting. You know, Jordan, many Americans feel that economic growth disproportionately benefits the wealthy. What factors are contributing to the middle class squeeze? And has wage stagnation played a bigger role in middle class struggles than rising costs? Are both equally significant?
It's a combination. I mean, they feel their costs are going up. Everybody today talks about eggs and how much eggs have gone up, but it's kind of symbolic of a lot of other kind of basic things that have gone up out of people's reach. And meanwhile, their incomes have not gone up enough to make up for the difference there. And I said the cuts that are coming, both directly, you know, federal workers, and indirectly, like Medicaid, are really going to hurt middle and lower incomes in a major way. So yes, I think people feel they're falling further behind. That's why consumer confidence has been falling lately, even though until today the stock market's been going up and, you know, real estate assets have been rising. A lot of people just don't feel it.
So Logan, how does the decline in home ownership rates among the middle class affect long-term wealth accumulation and financial security? And then are tax policies and government incentives unintentionally favoring the wealthy at the expense of the middle class?
Well, you know, I've always told you, Armstrong, on this program, that I think that American policies to get people to own homes is a real fallacy. And people should make the decision as to whether it makes more sense for them to rent or whether to own. And there's a large cost to owning a home. And, you know, a lot of people should be renting. So, you know, a government policy that directs us into ownership is basically there because, you know, there are subsidies, and those subsidies tend to go mostly to middle and upper income people. And I don't think it's appropriate for the government to be telling people, to be subsidizing middle and upper class people.
Well, Dr. Fofack, what industries or job sectors are most vulnerable to economic shifts that exacerbate wealth disparities? And what role do corporate practices such as the stock buybacks and executive compensation play in widening the wealth gap?
But before I respond to that, I think I have to say that that gap is also driven by what I call the disconnect between productivity and essentially compensations. I think productivity has actually grown consistently, while we've seen a gap in compensations, reflecting the mindset whereby the reward has been shifted to the top. I think that's a real issue. Unless we narrow the gap between compensation and productivities, the issue of income inequality will continue to be a major constraint to really share prosperity within the countries. I think going back to your questions, I think it is fair to say that when you look at the structure of the economy today, and in the past, what has actually been a social escalator has been the manufacturing sector. I think manufacturing has played a key role in creating well-paying jobs, and that's why President Trump is right in actually rebuilding the U.S. manufacturing base. And you saw what he did today in terms of semiconductor. That's important. It's also very important what he's doing in the automotive industries. And that's one important angle that I would definitely support in terms of creating the condition for the middle class to grow again in this country. Another important aspect that was mentioned is in the healthcare. And I think health costs have actually been a major drivers of poverty in this country. And I often say that the poorer one is just one health shock away from falling into poverty because of those healthcare costs. It's something that has to address. But going back to the last point that was made on housing, I look at the data recently comparing the gap between the wealth gap between those who own a house and those who are renting, and that gap has grown to more than $1.3 million. So housing ownership may still be a very important driver to really increasing wealth and reducing income inequality within the country.
You know, I notice you're shaking your head, Diana, and I also want you to comment on whether we can truly have a thriving economy if the middle class continues to shrink, and what can we do to reverse this trend?
Well, one reason the middle class is shrinking is because there are more two-income houses than there used to be. It used to be back in the 1970s, 1980s, that the share of women working outside the home was very small. Now it's much larger. Women not only are working routinely in the workforce, they continue to work into their 50s and 60s. So you have these two-earner households. They are in the top fifth. You have one-earner households in the middle fifth, and then in the bottom fifth, you have maybe one earner for every two households. And until we change that, which we don't want to change, we're going to continue to have this widening inequality.
You know, what are the key differences, Logan, in how the wealthy invest compared to the middle class Americans? And I know you're going to say you can invest when you have money, or you have a little more extra, you can invest. And so because the wealthy supposedly have wealth and they have money parked somewhere, certainly they can invest more. But are tax advantages also, such as capital gains tax, rates, and estate planning, giving the wealthy an unfair advantage in wealth accumulation? And can the middle class and others have that same advantage if they're educated to understand how to take advantage of it?
Well, I think the question of capital gains has to deal with what you do with corporate income taxes, because a lot of the wealth that people have in the wealthy class is in equities, and the equities are taxed at another rate. So, you know, taxes at the corporate level are somewhere between 20-25%. So you have to look at, you know, the retained earnings that most corporations have, which is available for investment, and it's the investment that creates the jobs and improve productivity in the society. You have to look at the level of of the taxation of corporations, in addition to the level of taxation on capital gains. So capital gains is really sort of a secondary tax on income that's already been, in many instances, already taxed.
You know, one of the things that we don't talk about enough is financial literacy, Jordan. And I'm wondering, does that really gain you access to wealth building and tools and sort of the major barriers which prevent the middle class from closing that gap?
Yeah, I think it makes a big difference. I mean, more schools are teaching financial literacy, which is a good thing. But still, a lot of people are running into a huge amount of debt. Credit card debt has exploded recently. A lot of people still don't participate in their 401k. They don't think they can afford it. So the people who are more financially literate invest better, grow their homes, have less debt. People who are less financially literate have more debt, lower incomes, less investing. So yes, financial literacy has a major impact on the wealth gap.
Yeah, so Diana, listen, are there investment strategies that others can adopt to improve their investment habits and build long-term wealth? Is it luck? Is it reading? Is it experience? Is it growing up in a family where that was the order of the day, you learn it at the feet of someone else? Or you just come up with this idea of a better widget? What is it? Because it seems like everybody, it doesn't matter what their background has been, has shown that there's a different pathway to creating wealth. Oftentimes, it's very unorthodox.
Well, one great idea the Labor Department had was to have people opt out of being in their company pension plan rather than opt in. So they are automatically put in the company 401k or earnings plan, retirement plan, and then it gets taken out of their paycheck and it goes in, and then they can pick where it goes. And it used to be they had to opt in. So this is a very interesting change, and that helps people build retirement savings. Another thing we have to do is make sure that when people change jobs, and there are a lot of people that change jobs every year, that they don't just take that money out and spend it. They need to roll it over into the next employer's pension plan or into their own IRA or 401k plan. Third, it's good to have discretion over the funds that you have for retirement. So say you are in some pension plan that's controlled by a union such as the Teamsters, and you don't have any control over where your retirement funds go, and they're not being invested to your advantage, or they're being put in some ESG, environmental, social, and governance funds, it's not going to do as well. So you need to not just have the money there, but have the discretion to be able to control where it goes, and keep it there.
I never knew you could cover so much financial information in less than 30 minutes, and we still are at the halfway mark. So there's so much more that's coming from this high-octane panel who understands the financial world. This is your voice in your future. I'm Armstrong Williams, and we'll be back.
It is easier to build up strong children than to try and repair broken men.
The streets are plagued with crime, violence, there's a lot of poverty, and it's all a result of lack of education that's happening in our schools. So it really is a crisis.
We come from very different political perspectives, but we've come to the same conclusion, and that is there is a crisis in the classroom. Children are being deprived of quality of life because they're being deprived of a good education. We must solve this problem. It's incumbent upon all of us to join hands together to get this done.
We can't afford to wait one more day before we address these issues, because every day we lose another child.
Let's stop the politicking. Let's stop the games. Let's really do something to give these kids a real chance at life and being a part of that American dream.
We need accountability for funding. Many of the districts where you're seeing very low test scores, students graduating with very low literacy and math comprehension rates, they are receiving a lot of funding. So where is the money going where our kids aren't being adequately educated?
If you believe every child is deserving of a quality education, please go to educationjusticefoundation.com. So what I want to do, I'm going to slow down this high-octane financial conversation. I would like to have our guests to input things that we have not talked about, that things have come to mind, but we're moving at such a speed. So I'm going to start with you, Diana. What's missing from this conversation?
Well, I think the thing that's missing that we haven't talked about is school choice, is the level of education. What education do you have to get a good job that'll enable you to go to the job 2, 3, 4, 5, 6 and move up the income chain? And we now have 15 states that are close to having universal school choice. You can take the money that would go to a public school and go to any school of your choice. And that's really important, not because the school might be better, but because if the schools have competition, if they know someone can leave, they're going to do a better job of teaching. And if you look at it, there's Medicaid, there's food stamps, there's all these services, and you don't have to go to the one next door. You can go to any doctor that takes Medicaid. You can go to any grocery store with your food stamps. The only school, the only service that's provided for free, where you have to go to the local one, is your local school. You cannot go, in general, out of your neighborhood school. And there should be a revolution. I mean, what if we told people you have to go to your neighborhood grocery store? They might say it doesn't have what I need, it doesn't have fruits, it doesn't have the kind of bread I like. But you tell them they have to go to the neighborhood school and there is no revolution, but there should be, because education and the skills you get are the path to getting wealthy.
Dr. Fofack, what would you like to add to this?
I think one aspect that we've not really fully covered is related to the critical role of antitrust law. And if you look at the historical perspective in this country, at some point, our antitrust law system was very vibrant and robust. And then the income inequality was much lower. I think it's important that we revive antitrust law. We've moved from state monopolies to private monopolies and large private monopolies. And that created a system whereby that income inequality that we talked about so well continue to grow over time. Unless we go back to really revitalizing and creating a vibrant antitrust law systems, we are set for challenge going forward.
I think we have a lot of freedom of entry, though. I think we have a lot of freedom. Look, we just heard that Skype was going to go bust. We're not going to have Skype anymore. And that's because these other companies have come in. As long as we have freedom of entry and we allow people to provide a better service. I mean, look, everybody thought BlackBerry was the cell phone to have. And then BlackBerry died and everybody has iPhones. And now they have Galaxies and some other kinds of phones. So I fail to see that there's a major, major problem with monopolies causing income inequality.
Logan?
I think there's a big change in the structure of the financial markets that's taken place. 50 years ago, there were a large diversity in the S&P and the various indices. And you didn't have the kind of concentration you have in the market today in the S&P, where you have the Magnificent Seven, where 7 companies are about 35% of the total value of one index. And part of the problem is if you look at what it costs to be a public company today, the places where you can invest your money into small startups is very limited. You can't, there are very few companies anymore that are public that have a value of less than $1 billion. It just costs too much to be in the market. So where do those companies go? They tend to go into the private markets. And so the share of companies, especially smaller companies and middle market companies, they're moving more to the private equity in private markets. And you don't have the same kind of visibility in the private markets that you have in the public markets. But the real problem with all this is that small investors can't invest in middle market and small companies and venture capital because they're not qualified investors. And so they're basically kept out of that market for regulatory reasons and other reasons as well, in terms of risk profile. So I think that's, this change in the stock market has, created fewer opportunities for your average investor, your average retail investor, to take place in investment opportunities that, where you can really make a lot of money.
Jordan?
I think one thing we haven't talked about so far, which is a major thing coming at us, is artificial intelligence, and it's going to have major impacts on everything we've been talking about. I think wealth inequality will widen. Just think of the hundreds of billions of dollars being invested now by, as Logan calls them, the Magnificent Seven, Meta and Google and Apple and Microsoft, in building up these huge large language models that's going to do all kinds of things we can't even imagine right now. I think it's going to eliminate a lot of jobs, and even some high-end jobs. Software engineering, the AI can do the computer coding for you. So we're not sure where it's going, but it's a major event coming at us that we really have to think about how it's going to affect income inequality.
On the other hand, it does make everybody can have a junior assistant. You don't have to have someone check your spelling. You don't have to call your mom and say, is this typed right? You just put it into ChatGPT and say, do I have any spelling mistakes or grammar mistakes? Then you can give your boss, someone who doesn't even speak very good English, can give their boss a perfect memo, a perfect email. You never have to have a typo again. And I think that's a huge advantage for people with low levels of education who might have typos that would then prevent them from moving up in the workplace.
That's true. That's a good thing, and it's going to allow more drug discovery and much more efficiency. But it's kind of the strong are getting stronger, and the people who can invest in AI are going to benefit from it. And a lot of people can't. You're right. It's democratized, but a lot of people, businesses, are not going to be able to keep up with the big guys investing billions in this.
You know, Dr. Fofack, how does the risk tolerance differ between the wealthy and the middle class when it comes to investment? And is there a systemic issue in how financial advisors and investment firms cater to high net worth individuals while overlooking middle class investors?
I think middle class investors and high-end investors are facing different constraints. And that's a starting point. I think the high-end investors have more flexibility and luxury to actually engage in higher risk tolerance than lower class. And the time horizon where they have not only an inflows of income on a regular basis, but also wealth, give them more flexibility in terms of looking opportunity cost of money. And that luxury is something that we do not see among the middle and low income classes, which are more constrained in terms of decision they can make. And those who can actually invest and go for wealth building in the lower and middle class tend to essentially go for certificate deposit savings. And those who engage in literacy, and I just put it so well, tend to not have the same attention as those who go to investors and corporations and with millions of dollars. You see a difference the way they are treated. So it becomes very important to really have a long-term strategy, even for those with little income, in terms of building that part consistently and in a way that within a number of years, you'll be able to actually have more support for those who actually have more access to the market and who should guide you in terms of the type of placement one will make. But it will require a lot of discipline within the family to arrive at that decisions. But quite frankly, those at the high end are really in a far better position in terms of flexibility. We mentioned the retirement package. They can actually max out on the 401k, something that those who are struggling will have difficulty making. But it's important to have that consistency and discipline, and for those who have low income.
Jordan, what has the concentration of wealth in the top 10% evolved over the last few decades, and what are the main drivers of this shift? And also, what are the biggest misconceptions people have about wealth inequality and its impact on the economy?
Well, I mean, what the drivers have been is the increase in asset values. The stock market's gone up dramatically over the last few decades. Real estate values have gone up dramatically. Gold has gone up dramatically. Crypto has gone up dramatically. If you had Bitcoin at 100, it's now 100,000, you're doing pretty well. So it's the people with assets that have benefited dramatically what's happened here, and taxes are lower because tax rates have come down. That's been the driver behind the whole thing. And then the inequality gap is that wages have not gone up very much at all, not as much as prices have gone up. So it's harder for people to buy basic things. They can't invest. They're basically trying to live paycheck to paycheck. So that's what's really driven the wealth inequality.
Your voice, your future. I'm Armstrong Williams, and we'll be back with much more.
As a home buyer, you need a lender who cares about your home ownership dreams. United Security Financial has been helping families secure their dream homes for 30 years. We're a national fair practice lender that provides affordable mortgages and low down payment programs to eligible home buyers. To learn how United Security Financial can help you secure your dream home, call 1-800-373-4186.
Share of bonds.
In this segment, we're going to talk about, Greg says stop talking as if that's possible. But anyhow, in this segment, we're going to talk about how you create that wealth, the risk takers versus those who are risk averse. You were talking during the break. Please continue.
Right. So I was saying that people have a choice as to what funds to invest in. They're often given a part stock market portfolio with part bonds. And the more stocks you have, the higher the risk, but the higher the return. High risk goes with high return. So we were talking before about the person who bought crypto when it was 100. So that individual took a risk, and that risk has paid off. So the more risk you take, you are going out on a limb taking that risk, but you can get rewarded, or it can just go bankrupt. You can just fail. And that increases wealth inequality, because some people do really well, they're super winners, and some people don't do well.
Logan, give someone a blueprint if they're watching the show tonight and they feel they're in the middle class, they don't have a lot of money, but they want to create a blueprint to wealth. What wisdom would you share with them?
Well, first of all, I'd start off with talking about diversification of your investments. And the diversification should include, and I'm assuming you have a lot of money in this diversification and you're not overly risk averse, but it should include a broad spectrum of investing in things like venture capital, private equity, public equity, and once again, depending on your stage of life, some less risky fixed income investments. But the key is to have diversification. And where you go along the efficient frontier in your investment strategy depends on the risk that you're willing to take. But as as your guests have said, if you're not willing to take the risk, you're not going to get wealthy.
Jordan, what is a blueprint for someone who says, I can't do anything because I'm over my head in debt? How do you advise somebody on a pathway to come out of their pile of debt?
Well, I mean, debt is very expensive today. Credit card interest rates are 25%, so it's very difficult to get out of it. You're right. I mean, the solution to long-term wealth is make it a regular habit. So certainly max out on your 401k, particularly if you get a match of some kind. You can set up an automatic investment program with individual companies and reinvest dividends. You could do it with mutual funds. Make it a habit and not an accident where you're starting to, you wait till the end of the month to save and then, there's nothing to save. Make it happen as automatic as possible, and then it's likely to happen. I mean, people who are retiring today have some pretty big balances from all the 401k money they put in over the last 20 or 30 years. The previous generation never had that. They didn't have 401ks. So that's the kind of consistent kind of investing that does pay off long term.
And they should start young. Start when they get their first job, take a certain amount, put it aside every paycheck so they don't even see it. Put in an IRA that's linked to the S&P 500, then they don't have to worry about choosing stocks. And then it just grows. Don't even open the envelopes. I'm
going to share a personal story since I asked how to start creating. Well, I would tell you, in my entire life, it sounds crazy what I'm about to say, I have never paid interest rates on a credit card. I have literally, every credit card I've ever had, I paid off within 30 days. And if I cannot afford to pay it off, I'm not going to charge it. You are being killed by interest rates. And you have no idea how you've been exploited. And I didn't realize that some of these interest rates are 30%. But listen, you should only charge certain things to your credit card, and if you cannot pay that credit card off in 30 days, you should not make that charge. Dr. Fofack, I just wanted to say that.
No, I think you're talking about your credit card. There's something called the money lenders and the credit card bills, and which is also very taxing on families, low-income families. We have your paychecks. You actually pre-engage expenditure. So, but when the paychecks comes, you're already very much in deficit. So one thing we should do in terms of well building and in terms of income growth, it's really to make sure that we manage our asset, our income properly. I think that's the most important and fundamental thing. If you miss on that, you may actually never get the chance to invest anything you can think of. So it's that's a very important point that we should make for a lower middle income country. But for the high income country, quite frankly, they have more flexibility in terms of decision making, in terms of asset allocations. We've discussed that in detail. It's very important to also mention the fact that we have now entered the world whereby we are not just investing within the US, there are also opportunities outside the US where we can actually access resources at much lower cost, given the interest rate differential. I just came from Egypt, where the rate is actually 25% in the bank to have a loan. We can actually get those loans at much lower rate here and invest abroad and make much higher return than what would be considered within the US.
There's also other lifestyle choices. For example, finish high school, go to community college and get a high-earning degree like computer programming, welding, plumbing, rather than taking out debt to get a 4-year education. Don't have a baby out of wedlock. Stay married. All those things help build wealth. Divorce is really expensive.
I want to also add this. What is your monthly budget, income, and expenses? What are your assets and your liabilities? Sometimes people don't want to know just how much money they spend every month because it would just overwhelm them. You should, for at least a month or two, write down everything you spend money on. I don't care if it's chewing gum, I don't care if it's toothpaste, whatever you spend money on, you should write it down for 2 months. And then you should also write down what you make every month. And at the end of that month, at the end of that 2 months, you take a look at exactly what you're spending, what you're wasting money on. And when you see it in real time, you will be shocked at your spending habits. And then and only then will you come out of the trauma and begin to change. You must see what you spend every day to realize that you've got to make a change. Jordan?
Let me give you a suggestion, actually. There's a website, a free website called You Need a Budget, YNAB.com. And does exactly what you say. You enter all your expenses. In fact, they link it to your bank account. So you don't even have to enter it. It just automatically goes in there in the different categories. And then you not only see what you're spending, but then you say, next month, here's what I expect to spend. And at the end of each month, you can see, are you more or less in particular categories? And it tracks it for you. This is very easy to do. Most people will be shocked as you see where they actually spend their money as opposed to where they think they spend their money.
That's a fact. Logan?
You know, one of the things we need is a cultural change. You do not have to keep up with the Joneses, okay? If you really want to become wealthy, you should look at a lifestyle where you can accumulate a certain amount of income. I mean, I have some aunts who lived to be 100 years old, and when they, in their late 90s, they asked me to manage their money, and I thought because they lived so modestly, I thought they were, they didn't have very much money to manage. I was shocked that they were multimillionaires because they put 10% every week into their bank account, and just sort of a consistency. And they did it since they were young ladies. And it's amazing what compound growth can do for you if you're not trying to keep up with the Joneses.
Diana?
You don't need a new car. A used car does fine. You can just, if you take a new car and you drive it out of the parking lot, it loses about 10 or 15% right there. So yeah, modest expenditures do fine. And as we heard, you don't have to keep up with anybody. You can also, you don't even have to go out for coffee. You can make it at home.
Since we're dispensing wisdom here, because I love this last segment, because I think this is important. I think Logan just said something that's very important for me and my household, because you work too hard to give your money to credit card companies and everybody else waiting around to take your money. That's the bottom line. Everybody. That's why you have fraudsters. That's why you have these people call and said you had this emergency. Your grandson is stranded. I'm here with them. Send me the money. I'm going to take care of it. Everybody's trying to get in your wallet. But one thing that you should always do every 2 weeks, however often you get a paycheck, squirrel away. You should set aside at least 20 to 30% of whatever you make every paycheck and just squirrel that away. You should keep something for yourself, and that should be within your budget. So you can have what we would call a rainy day fund, because you're going to have an emergency. Something is going to go awry that you're going to have to address. And it's the simple things where you're putting aside something that you've actually earned for a rainy day. Dr. Fofack?
No, I think you're raising a fundamental point. It turns out that consumptions is actually maybe the most important challenge in a way of well-building and income growth. It's very important that households begin to look at their consumptions to make a distinction between what is important and what is necessary, and have the culture of savings. And one main difference between the US and countries in East Asia today is that some of these countries have very huge savings. We've actually neglected that aspect, the culture of building savings, which will actually trigger wealth accumulation at the household level.
Jordan?
Take a look at the difference between delayed gratification and instant gratification. Everybody wants everything right away. You got to spend it right now, whether I have the money or not. But if you can do delayed gratification and save, you'll do much better later. The money that you're spending on all these little things now can be invested and compounded and really grow into something significant. So the whole idea of delayed gratification seems to have been lost, but helps an awful lot of people.
You know, I cannot say enough to Dr. Fofack, Ms. Furchtgott-Roth, Logan Delany, and Jordan Goodman, how much I, as the moderator, enjoyed this conversation today, because you guys really dispense real advice and wisdom, because wisdom comes from experience, and experience comes from having had bad judgment. So you shared your bad judgment on how they can learn to prepare for the future, not dependent on no one but themselves. Just a great conversation. Pass it on. I'm Armstrong Williams. Thank you so much for joining us. Thank all our guests for this edition.
Thank you.
Thank you.
Thank you.